On today's podcast, we've got some actual investing experts on. You no longer have to take my advice on things. Listen to what they have to say. Let's jump into it. Hi, everybody, and welcome to another episode of Dollars and Cents, Hapo Community Credit Union's financial literacy podcast. We are diving into the world of investing today, and joining us on the podcast, we have Tyler Pearson and Nick Haberling, both financial advisors with HFG Trust. Gentlemen, welcome.
Yeah, thanks, Scott.
Happy to be here.
Yeah. Go ahead and give a quick introduction of who you are, what you do to the folks listening, and then we'll dive into the topic.
Do you want to start? You want me to start?
Yeah, I'll start. So my name's Nick Haberling. I'm a financial advisor with HFG Trust. So HFG Trust has been providing financial advice and investment management to people in the community for 42 years now. I've only been there for 5 years.
I was going to say, if you've been there for all 42, you're looking very dapper.
I know. I look incredible. But no, only the last 5 years, and then 3 years before that, I worked at TD Ameritrade. And so it was good to spend some time at one of the larger custodians and then come back to the Tri-Cities and work with our wonderful clients.
Very cool.
Yeah. No, and then I've been with HFG here for about 4 years. Just completed the certified financial planner designation, which Nick has as well. And so that's kind of, one of the things that HFG pushes on people is, hey, we want our advisors to be educated. And so it's been a pleasure to work there the last 4 years.
Okay, that is actually a really good point, because you will almost always notice when meeting financial advisors that they have a slew of acronyms after their name, CFP being one of those. Do you guys have any others, like another dozen or so of those to your credit yet?
No.
No, not for us. So we want at HFG Trust, we want all our financial advisors to at least have that certified financial planner designation. And then we have a few others who've gone above and beyond the call of duty. They have their CPA and their CFA.
Okay.
Which add some additional expertise to the planning process.
But in general, the CFP is what you're getting for financial planning to help pretty much any of your clients navigate the financial and the investing world with focusing on their futures.
Yes.
Precisely
yeah,
there.
Absolutely.
Okay, so let's switch our gears here a little bit. I mentioned future. Let's start thinking about the past. How long ago should I have started investing if I haven't done it yet?
Ooh. I would say as long ago as you could, right? Isn't that the mantra is, it's never too early to start. So if you have the ability to save, then you probably have the ability to some extent to start investing. And the earlier you start, the better it's going to turn out for you over the long run.
So when we say the earlier you start, this is investing. We're not talking about savings, emergency savings accounts. We've done more than enough episodes talking about how people should set up their financial foundation. What is one of the first investments that people should be looking at doing?
Oh man, that's a great question. So I think it's not exactly a conversation about stock investing necessarily, but one of the biggest investments I think people make from the start is deciding, hey, what type of career that they want to go into and what sort of costs they're going to incur in that career. So every now and then I get invited to speak to high school students. And one of my biggest pieces of advice is making sure that they're investing the time to really look at the field of careers available to them. Make sure that those careers can provide for the lifestyle expectation they have, and then examine the different costs that those career might have for college education, maybe tenureship and whatnot. Because really your career is going to be a huge driver of the absolute dollars you might be able to save. Not necessarily a percentage, that's more your savings ratio. Mm-hmm. But obviously the higher your income, the more on an absolute basis you'll be able to put away at some point in your life.
Okay.
Yeah, no, I think that's probably the single most important thing. And when we talk about starting early, right, that's something you can start doing before you even have income, is really just putting thought into, what career are you going to be in, kind of how do you see that going? Now things change. But then, one thing I always like to come back to when it comes to the actual saving and investing portion, the joke I always hear is it doesn't matter how good of an investor you are. If you're not able to put the money away in the first place, right, then you're not going to get a whole lot out of it. And so in my mind, the second step of investing, or really the first step beyond what Nick said, is starting to put the money away, right? So it's not necessarily what are you investing in, but just making the habit of, and I'm sure you guys have talked about this in previous episodes, making it a habit to save is that's an investment in itself. And then you could jump into what are you actually putting the money into.
I was going to say, we have had those conversations. We've also talked about on compensation plans, items like, and again, it kind of goes back to the career thing, company match 401k type of a scenario. That is probably what I would assume most people's first investment really is. If you're taking advantage of those employment funded opportunities like a pension plan or a 401k, right. And actually utilizing the match that they're giving you. And I think that one of the things we've talked about on the podcast before is if you don't see the money, then it's very easy to save it,
right? Yeah.
Because with those, you're pulling it directly out of your paycheck, so it's just going straight over there. I don't have the opportunity, or I don't need to summon the willpower to actually go invest that money.
Right. Well, and you bring up a good point with the company match is, if I'm talking with 401k participants, the number one thing we always say is if you have an employer match, let's say it's 4% of your income, if you put in 4%, what's the return that you just got on your money that you put in? It's 100% return overnight. I mean, the company is effectively giving you a 4% raise just because you're choosing to invest in your future. And as far as investing goes, I'm not aware of another overnight 100% return, component. And so that's a pretty good place to start. And I think you're right. 401ks are a lot of the time, probably in early life, that's where your investing begins.
I was going to say, yeah, that is one of those things we looked at, like total compensation packages. And if the employer is matching, that is, like you said, it's a 4% raise. Yep. But I think a lot of people, when they look at it, they see it as I have to give up 4% of my income. But I think that's kind of one of those psychological things about like, well, I'll do that when I'm making more money.
Right.
Like that's probably not a thing that we should be having people want to do, right?
Yeah. Well, I think it kind of goes back a little bit to your question of like, hey, how early should you start investing? And I think similar to a lot of things in life, good habits start early. So really when someone first gets to their career, even if they don't have that employee match, it's a good habit to start getting those automatic 10% of their paycheck going towards saving towards their retirement. Even if they're not making a lot of money at that time, it builds that habit. And then especially if you're with the same employer over time or you build that habit, your income's going to grow. That 10% that you're putting in is going to grow.
Yep.
And then you're also never having to revisit that initial decision of, well, I'm taking 10% of money that could go to this. No, it's automated. You're not thinking about it. And then also, 5 or 6 years later, you look back at it and you feel some satisfaction at seeing the growth in that account, hopefully.
Yeah, basically taking that intentional part, whether you're moving it on a direct deposit into a separate account that you just don't have quick access to, or getting used to the fact that you're at 90% of your income. Right out of the gate, just knowing, hey, I can live on this, and that 10% is going off and doing work, creating kind of a delayed gratification, coming back and looking at that, realizing what 10% can accomplish over time. Because with investing, like we just did have obviously the 100% overnight success, but that's not the target here. Because you said that's pretty much the only one of that can do that. Otherwise, we'd all be doing all of those things.
Yeah, no, exactly. No, I think you're kind of touching on a good point where, we're talking about investing when you're young. And the most important thing and the reason people harp on starting early is because when you look at, compounding investment returns and compound interest, I think Einstein referred to it as the eighth wonder of the world. What's magical about it is not what you see between, say, 22 and 30. It's what you see between 55 and 65. It's amazing the exponential growth that you'll see, even at returns that are somewhere in the neighborhood of 6 to 8% instead of, the returns we're talking about with the 401k match, which is not even technically a return, but it's a fun way to look at it. And so that's, I think, really what we harp on is, the most important thing about investing is picking a plan, sticking to it, and then sticking to it for an extended period of time, really hopefully 20 to 40 years.
I was going to say, that is, I think about how much time I've got left before I can really start tapping into mine. Maybe I'm hoping less than 40.
Yeah.
But we're getting into that. You mentioned that it compounds over time. You mentioned a couple of different return ranges. How does somebody determine what it is that they're really aiming for returns wise? Is that based on like the career they choose? Is that based on the style of investing that they want to do?
Yeah, I would say I can handle that one, but
no, that's a good question there. So I think it's going to be more. So it's not going to be career related. There, I think the career is more of like the fuel that can go into the portfolio.
Okay,
it'll get you farther depending on how many dollars you can put in. But in terms of returns, I think we're going to look at asset classes instead. And so if we're looking at there's a relationship between relative risk. We'll use safety, quote unquote.
Okay.
Here, that's not the perfect term. And the amount of return that you should expect. So for the safest asset class in the world, that's going to be U.S. Treasury bonds. During the Great Recession time, they weren't yielding much. Nowadays, probably somewhere between 3.5%, 4.5% or whatever. And so that's going to be your risk-free rate. That's like the baseline rate that you should expect for any type of investment that you make.
Yeah, and you mentioned risk. Investing is inherently a risk. While the general consensus is that you're going to be earning on the money that you put into this, that's not a guarantee. Risk is a factor in all investing.
Yep.
Yeah,
exactly.
Well, I think it's important, kind of to define risk, and I'm sure he'll touch on that as he goes from the risk-free rate is what we call it, right, in the Treasury world, as we start to jump into maybe privatized, investments, securitized investments, and
yeah, no, so risk-free rate, that just means it's the safest asset class in the world, known to man. Maybe there's something on Mars safer. Who knows?
We'll find it eventually.
Yeah, it's the safest that we know about. And then escalating from there, you have your higher yielding corporate bonds. So they're going to be priced at above what the U.S. Treasury bonds are going to be.
Okay.
So maybe 5% just for conversation points. And then we're going to get to stocks where they're considered higher risk because your returns aren't guaranteed. If you think about a bond, ideally you're at least guaranteed interest payments and then eventually your principal. Stocks, you're not guaranteed anything, but hopefully there's some sort of earnings component and growth behind it. And if we're thinking about a global or like a diversified portfolio, just if someone wanted to own all the U.S. companies that exist, it fluctuates around 3,000 or so over the last 100 years. That portfolio would hopefully be returning about an average of annualized average about 10% per year. Now
so that's definitely up from our 4.5% on our safe move, but now we're increasing our risk.
Exactly. Now, when we say an annualized 10%, that's saying like, hey, historically you should expect 10% per year. What you will experience year to year will not look like that. Since 1926, 27, I think it is, we've had a minus 40 to plus 50% returns. And if we just look at the past couple of years, I think with 2022 we were down 23%, 24 up 25, and this year so far we're at 13.
Yeah, somewhere right around there.
Oh, and then I skipped 2023. 2023 I think was like a 22.
Yeah.
So those aren't 10%.
Even just within this year, we've seen, if you just look at the U.S. stock market, we've seen a decline of, I think it got down to 20% from the peak to the bottom, and then it's climbed its way back out of that hole. And so when I look at risk, if you're choosing one security or one stock, right, there is the potential for a total loss, right? When we look at a diversified portfolio of say 3,000, 4,000 stocks, the risk in my mind really becomes what we call volatility. And that is the up and down of the price change of your investments. And so we expect to be compensated over the long term, which is what we get our return, that 10%, because in the short term, we're going to see the price of those investments go up and down. And as long as you're willing to kind of stick out that roller coaster ride, if you will, you're likely to see those higher returns. But if you choose to sell out at the bottom, then it goes back up and you miss out on some of that climb. That's where those returns start to shift a lot.
Okay. So that, for whatever reason, in my mind, prompts day trading as a thing where today it's at this one, I'm gonna sell it here at this height, and then once it drops back down, I'm gonna rebuy it, and I'm gonna be hoping that change that I'm seeing is going to provide me an immediate return minus whatever my commission fees are or anything for the purchasing and selling. But what you're talking about as far as avoiding that volatility is scanning back, not looking at stocks at a day-to-day rate, but more at a year-to-year type of a rate.
Right. And really, most importantly, it's looking at why are you investing, right? You're not investing just for fun for the most part. You're investing towards a goal, right? And if your goal is 30 years out, then, the difference between, an 8% return and a 6% return this year is not going to be, likely it's not going to be a huge material impact on the long-term goal.
Okay.
And so I think if you really put the scope of, hey, I'm investing for my future, I'm willing to see a year where maybe my investments are down because I know, the data, the history shows us that over a 30-year period of time, those returns are going to average out to be around 10%, even though this year it might hurt to watch that portfolio balance drop 20%. If I just stay invested, then, I feel comfortable that I'm going to be able to reach my goals.
Yeah. And kind of maybe backpedaling a little bit to the day trading. Day trading is complicated because, usually if you're doing it, if you're trying to outperform the market, and that's something that people have found to be incredibly difficult to do. So Standard & Poor's, they release a report about once or twice a year called the SPIVA report, which is comparing active investment managers, their performance to their benchmark.
Okay.
And so the benchmark is just a combination of stocks that they're going to compare themselves to. So a common benchmark for a U.S. asset manager might be the S&P 500, top 500 companies in the U.S. And what their reports consistently show is that over a 10-year period, 90 to 93% of these asset managers underperform the S&P 500. So if you think about it, these are not just individuals, these are teams of very smart people with proprietary trading algorithms, perhaps, using some of the best technology, and they frequently underperform just buying the index and sitting and waiting.
So you mentioned index. The index fund itself is what, the 500 companies that S&P are talking about? How does an index fund work?
Yeah, so how an index fund is going to work is that for starters, the index is created, and you're trying to match, let's say the top 500 companies, the S&P 500. Now, the index fund is then going to be created by another company, we'll say Vanguard, State Street, or whoever, and they're just going to try to match that benchmark's market weighting throughout the year. And so that index throughout different parts of the year will say like, hey, no, this company now makes a larger portion of the index, and then the index funds on a given quarterly date or annual date, they'll then rebalance their fund to match this benchmark.
So basically, they're taking the pool of money from a bunch of investors who go into this, and then they are managing that investing beyond just from there into different companies with a different mix of how much they want to make it match out with this S&P 500 or something.
Yeah, I mean, I think a simple way of looking at it is, let's say in the S&P 500, NVIDIA has a market cap weighting, so that means the value of NVIDIA within this group of 500 companies is 4%.
Okay.
So that's a pretty big piece of it.
I was going to say, if there's 500 of them,
yeah,
most of them are going to be under 1%.
Yep, exactly there. So then an index fund, they're going to be trying to match that 4% weighting within their fund. And the index funds, there's plenty of them. Fidelity's going to have them. Schwab's going to have them. Vanguard's going to have them. State Street. So there's different funds out there, and they're all trying to match that S&P 500 benchmark.
Okay. So you've got a pretty good idea of what you're getting into with those, and you can expect kind of that consistent performance that will outperform 90 to 93% of the individuals or teams out there trying to do this day trading or other level of effort.
Yeah. Outperform those active managers over a period of time by just allowing the market to make its decisions.
Yeah. Effectively speaking, saying, slow down. You don't need to be that active to do this and actually come out ahead. Zooming out from that volatility, that up and down that you'll see on the day-to-day, to be able to basically, hey, I'm going to invest this 10% from my paycheck into this thing. I'm not going to see it. It's going to go away, so I don't have to even worry about it myself. I'm going to put it into these accounts, and I'm going to let somebody else manage that on the far side, and I'm going to just ride this out and look at it later and see that I'm suddenly probably not a billionaire, but a heck of a lot better off than I would have been if I had just thrown that into, say, a general savings account.
Yeah, exactly.
Yeah. But I think that's a big misconception we see in investing, is that it's complicated, that you have to do a lot of research. You have to understand the ins and outs of day trading and making active decisions. The reality of it is companies like Vanguard, Fidelity, State Street have made it very easy and very affordable to just purchase an index. And for the vast majority of people, especially young folks, that's the best way to invest. And like you said, it's kind of out of arm's reach. Maybe it's in a 401k. I mean, most of the funds that you see in a 401k are index funds.
Okay.
Some of them might be actively managed, but they're mutual funds nonetheless. And I think it's really an easier world to invest in today than it was 40 years ago.
I was going to say, and I think to me it makes sense that companies like Vanguard and whatnot would want to make this an easy thing for people to invest in. They don't want to make it complicated because they need a large base of people investing in it to create the fund, to then create the profit, to be able to buy into these companies.
Right.
Yeah. To be honest, I'm not as entirely familiar with the creation of the funds. I think in Vanguard's case, they're actually owned by the fund holders in some capacity. Don't quote me. But that's one of the reasons why they of all the fund providers, why Vanguard typically has some of the lowest expense ratios. And so those expense ratios are fees embedded within a mutual fund or ETF. And traditionally, Vanguard has done a pretty good job of keeping those pretty low.
Yeah, nice. So I have a bit of a shift here. I've got a question that I've been mulling over while we've been sitting here. We're talking about earning interest on our money, but most everybody out there is going to have some level of debt, credit card debt, mortgage, car payment, and that debt is going up regularly based on the interest rate that they've got going. What is the preferred choice as far as balancing paying off your debt versus getting interest coming in on something else? Like if I were to take out a loan of say $10,000 with a 5% interest and I can earn 10%, am I doing better by pulling that out and investing it and earning that 10% over time while I slowly pay off this at the 5%?
That's a loaded question.
That is.
Obviously, if you're in a vacuum, if you were able to earn a guaranteed 10% each year, right? That's arbitrage. That's a good benefit. Pay off the debt slowly while you continue to save and earn your 10%. The issue with debt that I see, and to kind of reframe your question a little bit, you mentioned credit card debt. That's an easy one to knock out. It's like, hey, if you have credit card debt at 25 to 27%, interest rate, that's got to be priority one. And to some extent, that is an investment, because that debt will continue to grow if you're making minimum payments on it. You need to go tackle that and then jump into maybe investing later. Car loans, right, with a decent interest rate on it, there's times where it might make sense to make your payments, pay off the car loan over the course of 5 years while you're still investing. Obviously, mortgages, especially coming out of 2020, people that have 2-3% interest rates, like that's a great place to be, and that's what I would call good debt to some extent. But I think really it's just a individual scenario, right? So depending on what kind of debt, where the interest rate's at, how many years left you have on that loan, is it a secure loan? Like, is there a car behind it, or is it unsecured? It's a credit card. That's all stuff that goes into my mind when I'm working with clients on, should we be investing or should we be paying off debt? Unfortunately, I don't think that there's a black and white answer for the most part.
I think a lot of it depends is a conversation that the debt has already been incurred, and we're trying to make the best play with what's on the field, or if we're evaluating a decision like, do we need to have debt in order to have this boat? Like, do we need the boat?
Okay.
Or there's the opportunity costs of do we take on this debt on a non-productive asset ultimately, or do we invest for our future?
It sounds like with very many things, we talk about financial coaching on the podcast regularly, that this is a individual scenario with a very distinct answer per person. I mean, not going to be one answer for everybody. I would think that there are certain situations where, hey, maybe if I leverage this asset, I can then invest in this other thing, and in the long run, really raise my wealth in general. Utilizing debt to create wealth is something that we've talked about previously on the podcast. And so I believe that's probably where that question came from. I doubt I'm going to be taking out an equity loan on my home in order to just invest that in something else, but that equity being, basically a tool, and like a mortgage being an investment in and of itself.
Right. No, there are definitely places where, leverage creates wealth. There's also thousands of scenarios we could go back and look at, from obviously, Joe down the street to Fortune 500 companies that have been over levered. And debt is dangerous. It can magnify returns, but it also can magnify losses. And in some points, it can actually, bankrupt you, because you do owe someone or something that money back. And if the investments that you think you're making that are going to outperform this debt, if you're not able to make your payments and the value of your investment's gone down, now you're in a lot of trouble. So it's just, again, not to go, hey, it's it's different for everyone, but it really is.
I mean, not everybody out there is going to be able to pull an Elon Musk and leverage X in order to, pay their AI company that they're creating, and balance those type of wealth scenarios.
Right. Yeah.
I think there is a stat that if for whatever reason that fell through, Elon Musk would lose like 80% of his wealth, which kind of makes an interesting question. A lot of people will look at Elon Musk and be like, he's rich. Well, is he rich or is he wealthy? And how do we determine what the difference between those things are? You guys have a good answer for a philosophical question?
Rich versus wealthy?
Yeah.
For me, maybe it's because I've been watching The Gilded Age on HBO. Free advertising. Maybe it has something to do more with maybe the time it takes to accrue that money, and maybe there's an element of flashiness to it. So maybe an element of personality and time. I feel like when we have conversations about wealth, it's more subdued and long time frames. It's usually not the newest car around. So maybe that'd be my definition.
Okay.
Of the difference.
I think you guys have promoted it before here, the book, The Psychology of Money. Mm-hmm. That book does a phenomenal job of, number one, laying out the psychology of money, but number two, kind of differentiating between rich and wealthy. And I kind of subscribe to the belief that, rich is a lot of the time having high earnings, being able to afford things. Wealthy is the ability to also save and having a rainy day fund, having an investment account balance. Wealth is what you don't see, I think, and rich is what you do see.
That actually tracks pretty well. I think I agree with both of those statements and sentiments. I also think that wealth is not necessarily calculated in dollars.
Yeah.
Being able to have the things that you wanted out of life, family, vacation, those type of things that maybe, vacation costs money, but at the same time, the experience in and of itself provides wealth to an individual who is growing up.
Absolutely.
And of course, then back to this topic, investing being a vehicle to provide that future wealth, whatever that may be, for each individual.
Yeah.
So back to our initial conversation. If we're at retirement age now, what would you suggest somebody just starting out do to really get there, to kind of reevaluate our topic? What's that first thing? Because we talked about picking your career to help kind of set you up and be aware of that. And we mentioned 401k, but what outside of that is that first move that like somebody just out of college should be looking at doing?
So, go ahead.
No, I was going to say, probably the main thing is once they have their first job or whatnot, making sure that when they're building out their lifestyle, mapping out like, hey, this is how much rent costs, groceries and all that they're incorporating that they need to be saving for retirement, and that they should be contributing about 10% of their income each month to those retirement accounts. And hopefully they're working for an employer that has that 401k match. Mm-hmm. So really that 10% is more like somewhere between 13 and 15%, perhaps. And I think that's really step one, is to get started on that habit early. Because as we might get to a little bit later, is that a key part of growing wealth, preparing for retirement, is time in the market, because that gives us more time for those dollars to compound.
Yeah, the 55 to 65 being much more productive than the 25 to 35 time frame.
Exactly.
Do you guys have a particular type of a product that you like to work with people out of the gate versus other ones that you're like, you know what, we can do this, but maybe it's a little high risk or unique, but you're willing to do it if a client comes in, they're just like, I really want to do this thing.
I think, for the young person that, like we said, got the jobs, taking advantage of the 401k, the two big decisions, and they're not really products, but they're places that you can put your money. You're right. You have Roth versus pre-tax, which is a tax treatment on retirement accounts, and we can jump into that a little bit. And then kind of what Nick touched on earlier, there's different asset classes. And to make it super simple, I break it down between stocks and bonds.
Okay.
And the general rule of thumb is that the longer your time horizon, the more quote unquote aggressive you need to be in investing. Now, that doesn't mean you're taking undue risk, but you're going to be purchasing stocks when you're younger, and you're not probably going to own any or very many bonds, because as we discussed earlier, bonds are going to have a smaller long-term return. Stocks are going to have a higher long-term return. So working with a young person, I'm usually encouraging them and educating them on what the stock market looks like, what it looks like to be a long-term investor in the stock market, and then getting them started with some level of a low-cost index fund, or maybe several to get them globally diversified, and then talking through with them the Roth versus pre-tax. And for a lot of young people, your wages start out lower, you're in a lower tax bracket. Roth probably makes some sense, and that's just due to the fact that you pay some income tax on it today, but then those dollars grow tax-free, whereas pre-tax is kind of the opposite. You get the deduction today, and then you owe tax on it when you take it out.
Yep. Would you rather pay tax on the $100 that you put in or the $1,000 that you take out?
Yeah, and it's really what it boils down to is, what tax rate are you paying today versus what tax rate do you think you're going to be paying in retirement? I've never met a 25-year-old that has a pretty good idea what tax rate they're going to be paying in retirement. So it's a tough question.
Yeah. No, a big thing that when you asked about products, not necessarily a product that we have, but typically when someone's setting up their 401k, they might fill out like a risk tolerance questionnaire for their investments. I think maybe a lot of advisors have a love-hate relationship with those, because it's hey, here's this questionnaire. And then especially if someone's not working with an advisor, they see the results like, oh, I'm a conservative investor, I should invest conservatively. And the fund that is conservative is like 100% bonds or something. And then every now and then you find like a young person who's in their 20s invested 100% in U.S. Treasuries. And you're like, well, in this case, the real risk here is like actually your investment's not growing enough. And actually there's a difference between your professed risk tolerance on this questionnaire versus your risk capacity, what you can actually bear to risk with your investments. In the case of that young person, they should be invested probably 100% in stocks, because the objective there is to grow the portfolio enough to where eventually when they're retired, they can start withdrawing from it. And they're just not going to get there if they're invest 100% in bonds.
So I'm assuming here that over time, working with your clients, you're going to be reevaluating and shifting this balance of what is at higher risk and lower risk to basically be like, hey, now that we've got, you're 10, 15 years away from retirement, we want to look at maybe avoiding that negative 40 something odd % stock market year and losing effectively like a third of your investment out here, and let's cycle you into something that's safer.
Right.
Yeah, I mean, exactly. If we think about it, really the end goal of investing and preparing for retirement is that at some point in time, you're going to start making withdrawals from these accounts. And it would be a very rude surprise if on retirement day, you're going to make your first withdrawal and you're down 30%. And now you're going down even further because you're taking money out of the portfolio now. So as the closer we get to retirement, the more of a focus we have on capital preservation. And so, historically that traditional retirement portfolio might be 60% stocks, 40% bonds, where those bonds provide kind of a ballast during those down markets.
So in that, I mentioned kind of like the potential of other more risky opportunities. How much do you guys deal with investing in things like cryptocurrencies?
We field a lot of questions. No, we don't invest as a firm into crypto, but we do have clients that have crypto investments, and obviously receive questions and field questions regarding Bitcoin and Ethereum and other cryptocurrencies. One of the things that we look at when we look at investments is there's multiple ways that an investment can reward you, right? The price of the investment, if you buy it for $10, it goes up to $12, you made a $2 profit, right? The investment probably also pays a dividend, right? So if it pays a 2% dividend, you got, what is that, 20 cents on your $10 investment. That's earnings back into your pocket as well. And one of the things we see with crypto, right, is there is no income that you're receiving off of that investment. Okay. There's also, with a publicly traded company, their earnings may grow, right, which in turn should make the stock more valuable. You don't see that with crypto as either. And so I think I'm not trying to say there's absolutely not a world where you should invest in crypto, but those are kind of some of our hesitancies from jumping into it at the firm level.
I was going to say, it doesn't work the same. It's obviously a different vehicle. And it isn't really supported by much in like the real world. Doesn't mean it isn't profitable.
Yeah, but you're only seeing the price fluctuation. Yeah. Is what it is. How much do people think it's worth, and how much are they willing to pay for it today?
I mean, at that point, you should be investing in stamps or sneakers because it's almost the same.
Gold, gold, stamps, sneakers. It's kind of a similar idea, right? There's people that make a ton of money investing in fine wine, right? But fine wine it depends on how much somebody's willing to pay for.
I was going to say, I will say at this point in time, I have lost a bunch of money in fine wine because I will just drink it. It's not getting resold out of my cellar in any way, shape, or form.
Maybe half full.
However, that is going to funnel into my wealth. As we talked earlier, because I'm going to enjoy that. It's going to be a fantastic evening when I pop open one of those nice bottles of Leonetti or something along those lines.
Right.
Exactly. Yeah. And then also when we talk generically about crypto, there's different coins. There's, what are like the different images and all that good stuff. And they're going to have each different market dynamics, and also have like different whales. Those are large investors who might be pulling the strings. So I think there's just a lot of inefficiency and uncertainty when someone's playing with crypto.
I was going to say, there's a couple that have been around, like you mentioned, Bitcoin and Ethereum, that have been around for quite a while. And then there's some that were effectively flashes in the pan. You've got some social media personality that thinks they're going to stand up the next amazing cryptocurrency, and within 6 months, hundreds of thousands of people have lost whatever they put into it.
Right. Yeah. Well, and if you look at the history of stock investing, and when regulation really started to grow, there was people doing similar things that's going on now in the crypto world back in the 30s and the 20s that were able to push stock prices up and then get out of it, watch that stock price fall. They just made a whole bunch of money, but everybody else gets stuck. We've seen that in the crypto world, and with limited penalties because it's still a fairly unregulated market. And when that market gets regulated, only time will tell what that looks like, but it will have an impact on how crypto is traded.
So that's a really good point. Let's take a look in our crystal ball. What does investing start to look like in the next, say, 10, 20 years? Considering things like crypto that exist and how things happened back in the day that have changed the market today. Can people still be expecting to have their investments look the same? Is there new stuff that you see on the horizon?
Yeah. Well, it's a great question. And what I always go back to with clients, and because we get this question, I think, well, how do we, know what the next 20, 30 years are going to look like? And I think one thing that gets lost, especially in today's age, is that, you're buying stocks. And I know people that say, well, it's just like, it's just like the lottery. Like you're just buying, stocks. There's nothing going on there. And like, it might go up, it might go down. But the reality is you're actually investing and becoming a part owner in companies, right? And so what you're doing is you're participating in the economy. So if we take the United States economy and we take their publicly traded markets, if you buy the S&P 500, you just became a part owner in all 500 of those companies. You're participating in the earnings growth. You're participating in the growth of the United States economy. And so when I look at the future of investing, I'm really looking at it as, do I believe that the economy of the world is going to continue to grow? And I do, because the economy of the world is persistent. It needs to be persistent for everybody's sake, right? And people, at the end of the day, people are trying to make money that are running these companies. And so, what companies are at the top, that will change. AI is going to have an impact on our economy. Crypto is going to continue to get regulated. We're going to see that change. But at the end of the day, I'm a believer that if you invest in, kind of the economy, that you should see similar returns over the long run.
Yeah, no, I agree there totally. When looking at returns 10 to 20 years out, there's probably going to be some sort of recession within that period of time, maybe a couple. It's going to look similar to the past, probably in terms of investment outlook. There could be changes in terms of maybe the architecture behind how investing is done. I'm not sure how much the end user is going to notice that. I wouldn't be surprised if stocks sort of move to some sort of blockchain or cryptography feature. A number of months ago, I was going through some old client files and saw some cool stock certificates. So I don't know if maybe the blockchain will be able to allow people to see stock certificates or some kind of old school thing like that. It's totally possible there could be some sort of new investing vehicle, similar how mutual funds have sort of transitioned to exchange traded funds. I don't know what that vehicle would be. It'd probably depend on tax laws and whatnot. So I could anticipate some architectural changes. But in terms of the investing experience and the fundamentals of investing for the long run, I don't see much changes there.
I was going to say that's kind of the point in the game is we're looking 40, 50 years out, like at the beginning of your investing career, as it were, and you're, go with the flow, but it's not just a set it and forget it type of a thing. It is a check in. Let's see where we are. Let's see how things shift. And that allows you the opportunity to adapt to whatever changes may be coming.
Mm-hmm. No, exactly. And I think that check-in piece is pretty important because even though while maybe someone's investing situation might not change very much over the years, or it's fairly predetermined in terms of the stock to bond allocation mix, there's a lot of tax implications or tax things that might change in someone's life as they move up the income spectrum or as they go down the income spectrum as they near retirement.
So one of the things that I did ask very early on, we kind of focused on most of this the way through this, was how young is too young, how early is too early. Let's get a quick counterpoint to that. How late is too late to start investing? Obviously, if you're being lowered down in the pine box, you've missed the boat on investing if you haven't done it at that point in time. But is it once you've retired? Is it based on actually having an income stream to work with?
Yeah, I think what we see in retirement, right, is traditionally. So if you look back at people that retired in maybe the 70s, 80s, the pensions were a really big thing. Mm-hmm. And so if you had pension and Social Security, that's probably going to take care of a good portion of your income need in retirement. Unfortunately, the private pensions are about a thing of the past. And so now it's really up to the investor to build that nest egg that they're going to be able to take income off of in retirement. And so the question, how late is too late? It depends from person to person, obviously. But what we see is people that start investing 5-10 years before retirement, they come in, maybe they haven't talked to a financial advisor till just now, and we're running through a scenario with them. And really what their options are is that they either have to work longer or they have to choose to spend less. Mm-hmm. And those aren't fun options. And so the earlier you start, well, now you have the ability to save more, from the get-go. And I think that's a more fun option for a lot of people as well. If I just start putting away more money today, let time do the work. When you only have 5 years, you can save a lot of money if you have high earnings, but there's just not a lot of time for the investments to go to work for you.
You're gonna get a little bit, but it's gonna be, like we mentioned, that first 10 years, that 25 to 35 time frame isn't the big earning. It's in the long run that you're really getting it. So it's not like you're failing at investing at that point. You're just not going to see those big returns.
And the time horizon that we've talked about, right, where younger people can afford to take on more risk by investing in stocks and get the higher returns. If you're somebody who's 55 that wants to retire at 65, you only have a 10-year time horizon. We can't consciously put you into a portfolio that's 100% stocks, because if stocks are down over the next decade, you lost money. And so you also aren't able to, you don't have the capacity to take on the risk that you need to take to get those 8 to 10% returns that we've talked about.
So you're looking at really having to have a bit of a hard talk with yourself about what is my eventual retirement plan looking like? What am I capable of accomplishing?
Exactly.
And what do I need to have accomplished? And then, of course, how the heck do I get there?
Right.
There's not a whole heck of a lot of options there.
No, so it's sometimes we have to play the field how it is. There's some tough decisions that have to be made. I'm sure we could probably create some sort of scenario about like it being too late, where maybe someone's present value of the subsidies they'd get from maybe government programs is more valuable than the amount of assets that they would grow over a period of time. And if they had those assets, they wouldn't qualify for those programs. I'm sure those scenarios exist.
Where they actually legitimately shouldn't be investing anything. But even coming in with, say, a 10-year horizon, investing is still going to get you something. Yeah. So it's still not too late at that point in time.
No, exactly. And it really comes down to your objectives. And then also it could be, as someone investing for themselves versus maybe the money that they're putting away is for grandkids or a child. And that just naturally extends the time horizon, even if they're older themselves.
All right, gentlemen. Quick question, final thoughts, given everything that we've covered today for people who are looking to invest, people who obviously should come and meet you at HFG Trust and have that conversation.
That's right.
What do you got for people listening as a final thought on this?
Oh man, Tyler, I think you should go first.
Oh yeah, that seems convenient. No, final thoughts. Honestly, it's never too early to start, and the best time to start investing is now. Like we said, there's probably not a lot of scenarios where it doesn't make sense to get going. And everybody's in a different situation. Yep. I mean, we're people too. We recognize that things pop up, expenses pop up. And so if 2% of your income, 3% of your income is all you can possibly muster today, then, get after it. You'll thank yourself later. And over time, you just bump that up 1% a year. If you're getting a cost of living raise every year, then, you're hardly going to even notice that you're saving a little bit more. And so I just think it's an encouragement to everyone, regardless of whether or not you use, us as a financial advisor or choose to go at it on your own. It's just getting after it and putting money away for your future, and your retirement self will thank you.
Yep. No, I wholeheartedly agree there. I think for me, the biggest takeaway is that the decisions you make today will impact where you're at tomorrow. And it's important to make decisions that grant us more opportunities rather than box us in. And so investing now, even just a little bit, getting started on that habit can go a long way and really pay dividends, especially if we're able to invest for 10, 20, 30, 40, and even 50 years for some people.
Hey, gentlemen, thank you very much for joining us. I think the last thing that I would tell people is we did have a bunch of scary words that came out in here that people probably just maybe have gotten introduced to today during this episode. But the investing world in and of itself isn't exactly scary. It is, I would almost say, a necessity for most people to do. And if you find yourself thinking that the topics that we covered are concerning or disconcerting or scary, having a conversation with a financial advisor is the way to belay that fear or concern and allow you to stop delaying getting to a point of investing in your own future. Gentlemen, thank you so much for joining us on the podcast today. I appreciate it. And until next time, this has been Dollars and Cents, Hapo Community Credit Union's Financial Literacy Podcast. See you later.